Okay, dear students, in today's class, we'll be discussing in this live revision class of SBR, we'll be discussing one question of the past paper. I'm just writing the name of a question, then I'll share the question shortly. The name of the question is Benito. This question came in December 2023. So it's a 25 marks question, and predominantly this question is on Ifrs 16 leases. With a little bit, I would say, flavor of Ifrs 15 is there. That is revenue from contracts with customer. And another very important, I would say, topic which examiner has asked in this question, that is, you can say, ratio analysis. Ratios. Now, before discussing the entire question, one area which has been examined a lot in this question, that is sale and leaseback. That lessee is selling the asset, and after selling the asset, lessee is getting the same asset back on lease. Now, basically, either the transfer of asset is qualified as a sale or not. We will decide that according to IFRS 15, revenue from contracts with customer. Obviously, if seller, lessee, let's say, has transferred the asset, and let's say transfer has qualified for sale, after that we'll go for the lease back accounting. Now, the question is, when do I know that when the transfer qualifies for sale? It's very simple. When the control of the asset is transferred, make it more easier. According to IFRS 15, revenue from contracts with customer, when seller has fulfilled its performance obligation by giving control to the customer, and customer, after getting the control, can utilize the asset according to their discretion. So simply, seller has fulfilled the performance obligation. After that, buyer is having the control of that asset, and buyer is in a position to utilize the asset according to his or her will. Okay. Now let's say, according to IFRS 15, transfer has qualified as a sale. Now the same asset has been taken back on lease. Now, what is the accounting for that? How do we calculate value for right of use asset in case of leaseback? Now, there are three possibilities. I'll be discussing first all three of them. Then I will share the question, and then we'll be discussing the entire question. Properly. Number one. Now, there are three possibilities in case of sale and leaseback. Number one, that sale proceed is equal to the fair value. If the sale proceed is equal to the fair value, how will you calculate the value of right of use asset? Right of use asset is equal to, I'll take the lease obligation, amount of the lease obligation, divided by fair value of the asset, fair value of the asset, into carrying amount of the asset, into CA means carrying amount of the asset. So how will you calculate right of use asset? When the sale proceed is equal to fair value, right of use asset is equal to lease obligation divided by fair value of the asset into carrying amount. Now, second possibility, let me change the color. Second possibility, the sale proceeds, let's say the sale proceed is less than fair value. Assuming the sale proceed is less than fair value, I'm just assuming that sale proceed is, I'm just assuming, is 5 million. Assuming the fair value is 6 million. In this case, the difference 1 million is treated as prepayment. According to IFRS 15, when sale proceed is lower than the fair value, then difference is treated as prepayment. Okay. Now, how will you calculate right of use asset? Right of use asset is equal to, we'll take lease obligation, value of the lease obligation plus the prepayment amount, let's say, which is 1 million, divided by, in the denominator, you will always have the fair value of the asset. Fair value of the asset into carrying amount of the asset. Now, third and the final possibility. There is a possibility that selling price is more than the fair value. Assuming it is 8 million and the fair value is 6. If this is the case, then additional is the loan component. Additional is a financial liability. If sale proceed is more than the fair value, then excess amount is actually representing a financial liability, is actually representing a loan. Okay. Now, how will you calculate right of use asset? Right of use asset is equal to lease obligation, which examiner has given you, minus the financial liability. Because on lease obligation, I'll be applying IFRS 16. On financial liability, I apply IFRS 9. Divided by fair value of the asset, again into carrying amount. So there are three possibilities. One, sale proceed is equal to fair value. Then how will you calculate right of use asset? I've explained. Second, there's a possibility that sale proceed is less than the fair value. Difference is the prepayment. Third and last, sale proceed is more than the fair value, then additional amount is actually representing the financial liability, the loan component. Now, how will you calculate gain or loss when transfer qualifies as sale? And we have taken this, lessee has taken the same asset back on lease. In that case, logically, the gain or loss will only relate to the portion of the asset which we have transferred. Debit, credit. Let's say cash or bank is debited by the consideration which lessee has received by selling the asset. Debit right of use asset. And there are three possibilities of calculating this right of use asset amount. I've discussed all the three scenarios. Credit the property, plant and equipment, the asset which we are selling it, the asset which transfer has qualified as sale. So credit property, plant and equipment. Now what? Credit lease obligation. Now listen carefully. If it is the scenario number 3, then other than lease obligation, we will credit the financial liability as well. For example, your lease, I'm just assuming, okay? For example, your lease obligation is, let's say, 7 million. Out of that 2 million is a financial liability. So what I'll do, I'll say lease obligation credit by 5, financial liability credit by 2. If it is not case number 3, let's say it's just a simple case number 1 where sale proceed is equal to the fair value. So bank debit, right of use, asset debit, property, plant and equipment credit, lease obligation credit. Now listen. Gain or loss on transfer will be the balancing figure. Gain or loss on transfer will be the balancing figure. If the balancing figure is coming on a credit side, then it will be gain on transfer, and that will go to obviously P&L. That will increase the profitability of the company. If the balancing figure is coming on a debit side, then it is a loss on transfer. And obviously that will go to the P&L. It will reduce the profitability of the company. So simply either it is a gain on transfer or loss on transfer. It depends on the balancing figure. I'm assuming if it is a gain on transfer, if it is a gain on transfer, then it will be credited. If it is a loss on transfer, then it will be debited. So simply with the consideration which lessee has received bank debit, right of use asset debit. How do we calculate right of use asset? I've explained all the possible formulae. Property, plant and equipment credit, lease obligation credit. If there's a gain on transfer, then it will be credited. Obviously, if there's a loss, it will be debited. Now, one more possibility. If transfer does not qualify as sale, if transfer does not qualify as sale, then whatever consideration lessee, number one, if transfer does not qualify as sale, number one, lessee will not de-recognize the asset. Second point, whatever consideration lessee has received, it will be treated as a financial liability. When transfer does not qualify as sale. When transfer does not qualify as sale, number one, lessee will not de-recognize the property, plant and equipment. Number two, whatever consideration lessee has received, that consideration will be treated as financial liability. Let's say cash or bank will be debited and financial liability will be credited. Okay. Now, students, we can discuss the question Benito. And let me tell you one more thing. Even before doing this question, I have already explained the entire IFRS 16 leases in my previous lecture. And one more thing, those that are watching this lecture, let's say on YouTube, and let me tell you one thing. In our grand live revision classes, I have the commitment of discussing at least 20 questions of SBR from the recent past paper. All these 20 questions, they will be additional, they will be other than the question which we have already done in our pre-recorded course. And these live revision classes, I'm just not conducting only in SBR. ASA is conducting these live revision classes in all the papers like ATX, AFM, all the skill levels. So let me just share the question and let's do the entire question, Benito. Okay, dear student, let's just start the practice question. September, December 23, the grand live revision class is going on because we did not complete all the questions in the previous class. Benito question, this question, Benito came in September, December 2023. It's a 25 marks question. And this question covers, I would say, very comprehensively IFRS 16 leases, especially sale and leaseback. Plus, it also covers a really good discussion on ratio analysis. As I mentioned in my lectures as well, when you are preparing yourself for SBR, so your preparation has to be balanced. Balanced approach means if you're just focusing on, let's say, consolidation, ISS and IFRS, so you are focusing to me, according to me, you're focusing around 75% of the paper. You need to focus on ratio analysis as well. You need to know the current issues, especially S1, S2, standards on sustainability. You need to know the alternative performance measure as well. And you need to know the framework also. Then we'll say you are preparing yourself for SBR and following the balance approach. So let's read the question requirement. Okay. In accordance with Ifrs accounting standard, describe how an entity assesses whether transfer of an asset qualified as sale in a sale and leaseback accounting. And that is A1. So it's very simple. How do we actually conclude that particular asset we have sold? It's very simple. Number one, we have to use the guidance of IFRS 15, revenue from contracts with customers. When seller has fulfilled its obligations, that is, when seller has, let's say, fulfilled the performance obligation. And how do I know that, being a seller, that I have fulfilled my performance obligations? Basically, when the control of the asset is transferred to the customer, then we say that you have actually fulfilled your performance obligation. And when the performance obligation is satisfied, then your sale is treated as a sale. So simply what you need to write for A1, that according to IFRS 15, that is revenue from contracts with customer, sale will only occur when seller has fulfilled its performance obligation, obviously by transferring the control of the asset to the customer. In that case, we'll say that you have sold the asset. Okay, now A2, explain how sale and leaseback transaction are dealt with the seller lessee in accordance with IFRS 16 leases if the transfer of an asset qualifies as sale. I think I did explain this in the previous class. If, let's say, transfer of asset is qualifying for sale and we have taken the same asset back on the lease, then there are three possibilities. If you recall, number one, if the sale proceed is equal to the fair value, then how will you calculate the value for right of use asset? Right of use asset is equal to lease obligation divided by fair value of the asset into carrying amount. And simply, the double entry is right of use asset will be debit, bank or cash will be credit, lease obligation credit. Then let's say we have a property, plant and equipment, de-recognize that. Now, balancing figure, either it will be a gain on transfer or loss on transfer. If it is a gain on transfer, it will be credited. If it is a loss on transfer, then it will be debited. Another possibility, the selling price is lower than the fair value. If the selling price is lower than the fair value, then difference is treated as a prepayment. Then how I'm going to calculate right of use asset? Lease obligation plus the prepaid amount divided by fair value of asset into carrying amount. The rest is the same double entry. Third possibility, the selling price is more than the fair value. Can I say when the selling price is more than the fair value, then simply excess is treated as loan, as financial liability. And while calculating right of use asset, what do we do? From the present value of lease obligation, we deduct the loan amount divided by fair value of asset into carrying amount will give you the value of right of use asset. So there are three possibilities. Either you are selling, your sale proceed is equal to fair value. It could be higher than the fair value. It could be even lower than the fair value. So you need to discuss that. Third, explain how sale and leaseback transaction are dealt with by the seller, lessee, if the transfer of an asset does not qualify as sale. Okay. If transfer is not qualifying as sale, number one, lessee will not de-recognize its asset. Number two, whatever consideration lessee has received, simply bank is debit and financial liability will be credited. Repeat. If sale is not qualifying, if the transfer of asset is not qualifying as a sale, if transfer of asset is not qualifying as a sale, then whatever consideration, number one, lessee will not de-recognize its asset. Second, whatever consideration lessee is received, just bank or cash will be debited and financial liability will be credited. Okay. Fourth, explain the effect on the accounting treatment. If a sale and leaseback agreement contains a call option under which seller lessee can, at its option, repurchase the property. Good. Actually, we know that call option means right to buy. Call option means right to buy. Okay, now, if lessee is selling the asset, but also having the call option, means lessee is having a right to buy. Now, in that case, sale will not be treated, transfer of asset will not be treated as sale unless the option expires. Repeat. If seller lessee is having the call option means right to buy. In that case, the transfer of asset will not be treated as a sale. It will only be treated as a sale when the call option expires. So it means that if lessee is selling the asset, taking that asset on the lease back, but with that lessee says, I have a call option as well. Then obviously, according to Ifrs 15, revenue from contracts with customer, transfer of asset will not be treated as a sale until unless your call option expires. So it means that in two situations, the accounting will be same. One, when lessee sells the transfer the asset and transfer is not qualifying as a sale. And the second, when lessee seller says, I have a call option. In both the cases, the accounting is same, and the accounting is whatever consideration you have received, debit, financial liability will be credited. So student, for the 9 marks, you have to actually explain all these 4 areas. And they're saying there's no need to refer any exhibit for answer part A. It means that if you just have a really good grip on, I would say, especially on IFRS 16 leases, including IFRS 15 as well, so very easily you can answer all the points. Describe how an entity assess. We decided according to IFRS 15, revenue from contracts with customer. Transfer. When seller has fulfilled its performance obligation, then transfer of asset is treated as a sale, and fulfilling of performance obligation means simply the seller has transferred the control of the asset to the customer. And normally, when the control is transferred to the customer, normally it means sale has occurred. Then it says explain how sale and leaseback transaction are dealt. I have explained 3 scenarios. If you have time, go then discuss all the 3 scenarios. If you don't have so much time, then at least discuss how will you calculate gain or loss when you are taking the same asset back on lease. You need to discuss how will you calculate right of use asset carrying amount. Third point is explain how sale and leaseback transaction are dealt with by seller lessee if the transaction of asset does not qualify as a sale. So actually point number 3 and point number 4, for the explanation of point number 3 and point number 4, the same accounting applies. When transfer of asset is not qualifying as a sale, then whatever consideration you have received debit, but the financial liability will be credited. So let's see quickly. Part A of the question. The entity assesses whether transfer qualifies as a sale by using the guidance of IFRS 15 revenue from contracts with customers. Please notice one thing. You should note this. we are just not, examiner is just not giving the reference of IFRS 15. Proper name is written, IFRS 15 revenue from contracts with customer. It means just writing IFRS 15 and not writing the name is not enough. So you have to properly write the complete name. A sale has occurred when the seller has satisfied a performance obligation by transferring control of the asset. Control refers to the ability to direct the use of the asset and to obtain substantially all of its remaining benefits. It means you have transferred the as you have given the control of that asset to the customer. When customer will be using that asset according to his or her own, let's say, discretion, and customer will be getting substantially all of the remaining benefits. 2. Accounting treatment if transfer qualifies as a sale. In fact, for answering point number 2, you can use the formulae also, which I have explained the 3 possible scenarios. The seller lessee de-recognize the asset, number 1. Yes. A right of use asset is recognized and is measured at the proportion of previous carrying amount of asset which relates to the rights retained by the seller lessee. So right of use asset is recognized and it's measured at the proportion of the previous carrying amount. A lease liability is recognized equal to the present value of lease payment to be made. A profit or loss is reported in the statement of P&L based on the rights transferred to the buyer lessor. Note that if the consideration received of the asset exceeds its fair value, this is accounted for as an additional financing. If the consideration is below the assets, it was prepayment fair value, then this is accounted as a prepayment of the lease payments. Subsequently, the right of use asset is depreciated over the lease term. Interest is charged on the lease liability using the rate implicit in the lease. I hope straightforward everything is from the IFRS 16. Accounting treatment if it does not qualify as a sale. The seller lessee, when the transfer is not qualifying as a sale, the seller lessee continues to recognize the asset. On its statement of financial position, the seller lessee accounts for the proceed from the sale and leaseback as a financial liability in accordance with IFRS 9 financial instrument. So simply whatever consideration lessee has received debit and financial liability will be credited. The effect of an agreement contains a call option. I think we have already decided when there's a call option, then accounting will be exactly same like accounting treatment if the transfer does not qualify as a sale. Let's see. If the transaction contains a call option under which the seller lessee can at its option repurchase the property, then such an option generally precludes sale accounting under IFRS 15. This is because the existence of a call option means that the seller lessee retains control of the property. Therefore, a sale and leaseback accounting does not apply with the asset remaining on the statement of financial position and the cash received treated as a financial liability. I hope the entire accounting should be clear to you. Okay, now let's see. And you can see one more thing. A 9 marks question, pure explanation, and in addition to that, no need to refer to any exhibit. It means that if you have a really good grip on relevant IFRS, you can easily get really good marks out of that 9. Okay, now. B. Using exhibit 1, explain in accordance with IFRS 16 the accounting entries for sale and lease back transaction in the financial statement of Benito on 1st January X7 if the head office transfer qualifies as a sale and does not qualify as a sale. Can I say if it does not qualify as a sale, whatever consideration I have received, debit and financial liability will be credited? Yes or no? I'm talking about the second one. If transfer is not qualifying as a sale, then whatever consideration we have received, simply debit, and financial liability, you can say loan credit. But when it qualifies as a sale, then we have to see the scenario. There are three possible options, if you recall. One, that lessee has sold the asset equal to the sale proceed is equal to the fair value. Second, it could be less than the fair value sale proceed. Third, the sale proceed could be higher than the fair value. Then three possibilities. And in each scenario, the calculation of right of use asset will be different. Okay, now let's read the question. Now let's see. Sale and leaseback. Sale and leaseback on 1st January X7, Benito sold its head office, which had a carrying amount of 3.75 million, to Benito for 7.5 million. January X7, Benito company sold its head office, which had a carrying value 3.7 million, to Otini company. That's a different name. Otini company for a cash 7.5. So the consideration is 7.5 million. On the same date, Benito has entered into a contract with Otini Co. to use the head office for 20 years, with annual payment payable at the end of each year. Both companies have correctly accounted for the transaction as a sale and leaseback. At January X7, the fair value of the head office was 6.75 million. The present value of annual lease payment is 5.47 million. Okay, now listen and listen carefully. Actually, can I say the sale proceed is higher than fair value? The sale proceed is 7.5 million. Fair value is 6.75 million. Can I say when the sale proceed is higher than the fair value, difference is loan, difference is your financial liability. 7.5 minus 6.75, I'm getting 0.75. So logically, the financial liability is 0.75. Okay, now, if you ask me the lease obligation, logically, lease obligation will be 5.47 minus the loan. So 5.47 minus 0.75, I'm getting 4.72. Logically, the lease obligation amount is 4.72, which means that right of use asset, if I calculate, I'll take lease obligation 4.72 divided by the fair value of the asset, which is 6.75, into carrying amount of the asset. The carrying amount of the asset is 3.75. Let me use a calculator. 4.72 divided by 6.75 multiply by 3.75. Students, I'm getting 2.62, then 222. Now, debit and credit. The cash which we have received, 7.5. Okay. The cash element is 7.5 million. Right of use asset, 2.62. Am I right? Can I say property, plant and equipment will be credited by 3.75? Lease obligation Lease obligation we have calculated 4.72. Lease obligation 4.72 or financial liability. I'll come to this property, plant and equipment. Financial liability. How much it was? 0.75. And I said the balancing figure will be either gain or loss. If the balancing figure is coming on credit side, then gain. If it comes on debit side, then it is a loss. If you check, I think the debit side is heavier than the credit side. So the balancing figure will come on credit side. Yes or no, please reply. It is coming 0.9. So gain on transfer is 0.9, which will come to the P&L. Gain on transferred. Then we have to show in the statement of profit and loss 0.9 million. Now the question is why we are de-recognizing property, plant and equipment. This is the question. Benito company sold what? Head office. So you can use the term property, plant and equipment. Got it? Okay. This is the scenario number 1. The scenario number 2. Can I say in the scenario number 2 when sale is not sale, when the transfer of head office is not qualifying as sale, in that case, whatever consideration we have received, it will be treated as a financial liability. So when head office transfer does not qualify as a sale, head office transfer does not qualify as a sale. In that case, can I say that whatever consideration we have received debit, simply financial liability will be credited. Now let's see what examiner has done. We are talking about this B, okay? B. Head office transfer qualifies as a sale because the consideration for the sale of the head office is not at a fair value. So 0.75 is a loan, financial liability, as additional financing provided by obtaining company. The present value of the annual payment of amounts to 5.47, 0.75 relates to the additional financing. So 4.75 is actually lease obligation. I think we did the same thing. At January 7, Benito measures the right of use asset arising from the lease back of the building at the proportion of the previous carrying amount of the head office, which relates to the right of use asset retained. This is calculated. How they are calculating, I think we did the same thing. So you could have done this by using a formula. Benito company recognizing only the amount of the gain which relates to the rights transferred to Otino. The gain on the sale is 3. How did we calculate 3? Sale proceed is 6.75. The carrying value of the property, plant and equipment is 3.75. But entire 3 you will not be taking this as a gain. Of which 2.1 million relates to the right of use asset retained by Benito. So if you look at this, we have directly calculated this. The right transfer to Otine are measured at 0.9. Look at this. Cash, right of use asset, property, plant and equipment, what examiner says, lease liability and financial liability. What we did, we have separately shown the lease liability and financial liability. And we both got the same result. Simply the balancing figure is 0.9. That is gain on transfer. Head office transfer does not qualify as a sale. When head office transfer is not qualifying as a sale, the head office will continue to be recognized by Benito company and its carrying amount at 3.75. A financial liability is recognized equal to the transfer proceed. I strongly believe the entire accounting treatment is clear to everyone. Yes or no, please reply. Gain or loss on transfer you can calculate with the help of a balancing figure. That is, I think, easier rather than putting yourself into more numerical part. Is this clear to everyone? Yes or no? Now come here. Okay. Part C. Using Exhibit 1, compare the impact of head office transfer qualifying as a sale and not qualifying as a sale. When it qualifies for sale, compare that with when it is not qualifying as a sale on Benito company's financial statement and key performance indicators. Okay, number one. Using Exhibit 1, compare the impact of head office transfer qualify as a sale. Now listen. When it qualifies as a sale, number one, property, plant, and equipment will be de-recognized. Second, there will be a gain on transfer in the financial statements. Third, can I say right of use asset obviously will be depreciated and but amount of the right of use asset will be 2.62 and that 2.62 is lower than the 3.75. The head office carrying amount is 3.75 that will be de-recognized. There will be a gain in the income statement 0.9. Right of use asset 2.62 will be recognized and then 2.62 right of use asset will be depreciated over the lease term. There will be a finance cost as well on lease obligation. Okay, now, if you discuss, if sale is not qualifying as, if transfer is not qualifying as sale, now try to understand. In the books of lessee, asset will remain at 3.75, number one. Can I say on this 3.75, depreciation will be higher than depreciating the right of use asset 2.62. So the lessee will be depreciating 3.75 and the depreciating 3.75 will result in a higher depreciation as compared to right of use asset. Another point. On entire 7.5 million, I think asset was sold for 7.5. Entire 7.5 million is treated as a lease obligation, as a financial liability. Can I say when sale is not qualifying as, when transfer is not qualifying as a sale, then entire 7.5 million is the financial liability, is the loan. Obviously, this will increase the debt in the financial statement. Plus, can I say finance cost will be higher on 7.5 million as compared to the lease obligation? Because lease obligation amount is lower than 7.5 million. So let me repeat. If transfer qualifies as a sale in the financial statement, there will be a gain on transfer. Second, property, plant, and equipment 3.75 will be de-recognized. Right of use asset 2.62 will be recognized. And 2.62 will be depreciated over the lease term. There will be a finance cost on lease obligation, no doubt about it. But when it comes to transfer is not qualifying as sale, then whatever amount company has received, it is a financial liability, it is a loan. The appreciation will be on 3.75. Finance cost will be on 7.5 million. Now let's see what are the ratios. debt to equity ratio. Now try to understand. When head office transfer is not qualifying as sale, entire 7.5 million is your loan. It is your financial liability. In that case, can I say debt will increase? Obviously, when debt increases, then your gearing will be higher. So can I say the gearing ratio will be higher when sale is not transfer is not qualifying as sale as compared to when transfer qualifies as sale. Because when transfer qualifies as sale, then lease obligation plus even the 0.75, I would say the loan amount, they are lower than the 7.5 million amount. So is this clear? When sale is not qualifying as sale, your gearing ratio will be higher. Okay, now earning before interest and tax. Earning before interest and tax. Now listen. When sale is not qualifying, when transfer is not qualifying as sale, we will depreciate 3.75. Can I say depreciation expense will be higher as compared to depreciating the right of use asset, which is 2.62? It means that when lessee will be depreciating 3.75 instead of 2.62, due to higher depreciation, can I say the profitability will be lower? So earning before interest and tax will be lower because of higher depreciation at 3.75. I'm not discussing anything on interest. Why? Because here we are saying earning before interest and tax. Even though when 7.5 million is treated as your financial liability as loan, your interest will be higher. On lease obligation, interest will be lower, but still that interest element is not affecting earning before interest and tax. Repeat. EBIT will be lower when when transfer is not qualifying as sale, because we will be depreciating 3.75. So depreciation expense will be higher as compared to depreciating a right of use asset, which is 2.62. And no effect of interest comes on EBIT. I hope it is clear. Asset turnover, sales divided by total asset. Asset turnover. Can I say when sale is not qualifying as sale, then your asset turnover will be lower. When sale is not qualifying as sale, then your asset turnover will be lower. The question is why? Because in my books, I'll be having a property, plant and equipment which is having a carrying amount of 3.75 million rather than right of use asset 2.62. So when transfer is not qualifying as sale, then asset turnover will be lower. Why it will be lower? Just imagine instead of 2.62, you will be having 3.75 in your books. So your denominator, you will be having more assets when head office is transfer is not qualifying as sale. Okay, now return on capital employed. Earning before interest and tax divided by equity plus financial liability. Now please try to understand what is happening. Number one, can I say when sale is not qualifying as sale, when transfer is not qualifying as sale, your profitability will reduce due to higher depreciation. Your profitability will reduce due to higher depreciation plus, it says equity plus financial liability. Can I say your financial liabilities will increase by 7.5 million? So very important point. ROCE will be reduced. Why it will be lower? Because two things are happening. One, profitability will be reduced due to higher depreciation when head office transfer is not qualifying as sale. And second, of course, the denominator will also increase due to financial liabilities. So a very important, I would say, student question. Here you have to explain the impact of a different treatment on different ratios. I really want every one of you to quickly just go through the answer and take out any queries so that I can reply immediately without wasting any time. Let's see what examiner is. First of all, I think call option point we have already discussed. The presence of a call option to repurchase means that control of asset will only transfer once the option expires. We have discussed this. Therefore, the treatment is same as if the transaction did not qualify as a sale. The decision as regards whether the sale and leaseback can be treated as a sale under Ifrs 15 can significantly affect performance ratios. If the sale and leaseback cannot be treated as a sale under Ifrs 15, the gross asset and liabilities will be greater for the seller lessee, and the asset remains on the statement of financial position, and the cash received is treated as a financial liability. The total debt will be higher, and this may have an impact with the loan covenant based on the total debt level, as it may lead to breach. Now, there's a possibility that on existing loan there is a covenant. If you take more loan, then there's a possibility that breach of covenant might occur. The difference in the treatment will also affect some profitability ratios because of the two elements, the depreciation and interest charge. The depreciation and interest charge will be higher in the case as the carrying amount of properties is recorded at a higher value than right of use asset. And interest charge will be higher as the financial liability is higher than the lease liability. Also, there will be no gain recorded on the sale of the asset, thus reducing profitability. Now, please just go through these impact, what examiner has written. If you have any issue, please, you can ask right now. I'm giving you 2 minutes, students. You have 2 minutes to go through. Please check this. Key performance indicator gearing, debt upon equity. Effect of sale and lease back on key performance indicator if transaction is not a sale. Gearing will be higher because the financial liability 7.5 million is greater than the combined lease and financial liability. I hope it is clear. The discussion on gearing. Please quickly reply. We did discuss the same thing. Student, please comment on that. Is this clear? The impact on gearing ratio. Okay, now earning before interest and tax. Great. EBIT will be lower because of a higher depreciation charge. Based on original carrying amount 3.75 million rather than right of use asset 2.62. So obviously the profitability will be lower. Again, I would say a straightforward discussion, no issue at all. And there will be no gain on sale because the transfer does not qualify as sale. Interest has no impact on earning before interest and tax because we are taking earnings which are before interest. So that is why. Asset turnover, sale upon total asset turnover will be lower because property remains on statement of financial position at its carrying amount 3.75 rather than 2.62 right of use asset. So obviously the denominator will be higher. So asset turnover will reduce. Return on capital employed, ROC will be lower because earning will be lower. Earning will be lower because of higher depreciation. Also, financial liabilities will be higher if the asset is not sold. If the transfer is a sale, equity will be higher because of the gain on the sale and reduced depreciation, but also earning before interest will be higher. But earnings will be higher when transfer qualifies as sale. Okay, just look at this, what is written. ROC will be lower because EBIT will be lower, as also financial liabilities will be higher if the asset is not sold. So if you are writing this much, it is good enough. After that, what examiner has written, if the transfer is a sale, now examiner is just, writing something additional. If the transfer is a sale, equity will be higher because of the gain and reduces that, because why depreciation will be lower, because we'll be depreciating then 2.62 right of use asset rather than the carrying amount of the asset, which is 3.75. And also earning before interest and tax will be higher. I hope it is clear to everyone the entire discussion. It's a really good question, I would say, on IFRS 16 with a flavor of 15 plus the ratio analysis. As I mentioned that, balance approach. If you are just focusing on few areas, then it is going to create the problem. It will create the problem. Okay. Give me 1 minute. Okay, student, still we are left with, I think, 2 questions. Am I right? Yes or no? So far, we have discussed 3 questions. Can you please quickly reply yes or no? We still have 2 more questions to be discussed. Okay. So we need to discuss 2 more questions, but I have a class as well. So, okay. So, student, is it possible? Can you people take one class tomorrow as well? So that the remaining 2 questions we can discuss. But it will be 2 p.m. Pakistan time. So we'll be just discussing those remaining 2 questions. So in this way, entire 5 questions will be completed, and then by Wednesday, what are we going to discuss in the second grand live revision class? I will share all the questions and the topics. At least I would say 5 more questions from the past paper. In this way, my target is to discuss at least 20 recent past paper questions with you in 4 grand live revision classes. See, we have already done number of questions in our pre-recorded classes, but if you can discuss 20 questions with me in the grand live revision classes, you are coming live online and discussing each and everything with me in live classes. I think that will be really good. Just imagine that you are doing 20 questions with your tutor. Then and there you can ask the question, you get the response answer quickly. So I hope it's going to be beneficial, and we are not, I'm conducting these grand live revision classes in every paper means every, in ATX, AFM, even the skill level, everywhere. So students, I'll be conducting for the remaining 2 questions. Let's take the class tomorrow 2 p.m. And by Wednesday I'll be sharing what exactly we're going to discuss in the next grand live revision class. So thank you very much. And those students, they are unable to come online for the live class, I would say please do not miss the recording. Do not miss the recording. Okay, students. Thank you very much. See you all inshallah tomorrow. Thank you.